Well, let me throw you a bit of a curveball, okay? So what about the tax bill? How does the tax bill affect the housing market?
Yeah, so the tax bill
And I know you're not a tax expert, so do the best you can here.
All right, so the tax bill, so it's not new. It passed at the end of 2017.
Right.
It's been in effect for all of 2018, and in fact, most people have probably already seen slightly higher take-home pay because the IRS changed withholding to account for the new tax plan.
Yep.
But no one's actually filed their taxes under this new plan because you file your taxes sometime between January, February, and April when they're due. So that's when it's really going to hit home for a lot of homeowners and renters. Are going to see exactly how much they benefit or lose out from this tax plan.
Yeah.
We know that the tax plan had a couple of changes that directly affect the way homeowners and renters are going to do their taxes. So for renters, they didn't really have a lot of tax benefits under the old tax plan.
Right.
So for most of them, it's going to be a positive. They were less likely to itemize deductions because of the structure in the old tax plan, and should be more like, so they should benefit from the higher standard deduction.
That's good to know.
For homeowners, they were likely to itemize under the old tax plan. About half of homeowners itemized under the old tax plan.
About 50%, huh? Interesting.
Because you have to have mortgage debt. So about a third of homeowners don't have any mortgage debt. So they weren't necessarily key or likely to itemize. So they're less. So homeowners are more likely to itemize, and they may not going forward because there's a limit on the amount of mortgage interest you can deduct. So
and that's the new part, right? I mean, basically, when you talk about itemized, you're talking about basically deducting it. So it was a powerful deduction for homeowners. And you were saying that now there's a cap, so people really can there's a limited tax advantage.
Yeah, for deducting mortgage interest. But actually, in fact, the bigger change is that the standard deduction, okay, let me take a step back. So there are two ways to do your taxes. You can either take the standard deduction, it's a lump sum, you subtract it, no matter how you spend your money, how much you give away, how much you save, it doesn't matter. You take the standard deduction and then you subtract that off your income, and then you pay taxes on the rest.
Okay, good.
Or you can itemize your deductions. So you don't take that standard deduction. Instead, you're going to list out specifically the tax advantage things you spend your money on. So you get to take money off for mortgage interest. You used to be able to take state and local income and property taxes unlimited. That's a change. So your mortgage interest is now limited. You can only deduct up to $750,000 interest on a mortgage up to $750,000 versus $1 million under the old tax rules.
Okay.
You used to get unlimited state and local taxes. Now you can only deduct up to $10,000.
Oh, wow.
Charitable contributions, you can deduct those from your income as well. That was unlimited, it stays unlimited, so no major change there.
That's good.
And there are some other minor tweaks, but those are the big ones. But ultimately, it only makes sense to itemize if the dollar amount of your itemized deductions exceeds the standard deduction.
Right.
And so the fact that the standard deduction into the new plan is roughly double what it was under the old plan means we're going to see way fewer itemizers.
Okay, I feel like that was a little mini tax course. That was awesome. So you're definitely more of an expert than you say.